Our mission at SD Bullion is clear: the lowest cost gold and silver available online. While we do not have pretty blue boxes, free shipping, 4% credit card fees, or glamorous gold and silver infomercials, SD Bullion has the lowest prices that may save you hundreds on your next order. So before you make your next investment, do the math and join the over 15,000 new customers who have recently made the switch to SD Bullion. Why pay more?
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us today on a week that gold and silver have been hit hard following the Fed minutes is our good friend Craig Hemke of TF Metals Report. It's great to have you back, Craig.
Yeah, what's up, Doc?
Duck season's up.
Bang, bang.
So let's start right off with gold and silver here, Craig. Gold's found support at $12.50 yesterday on Thursday. Briefly dipped below it, but jumped right back above it, and it's held firm here as support here on Friday. Silver also holding the line at $16.50. Again, yesterday briefly dipped below it, but the past 24 hours is $16.50 has been holding it. So what's your take here the past 48 hours trading and going forward?
Well, it looks to be some technical and fundamental support reasons for the price to hang in there. In gold, I think it was maybe a week ago, I recorded a thing for the folks at Sprott with Andrew McGuire. And one of the things he talked about was the wholesale bid level in physical gold in London had moved up to the 1250 area. And he said unless they moved it back down, it was going to be really hard for the banks to drive the futures price much below 1250 because it kind of puts them in almost a backwardation at that point because they're selling paper at 1245, but they got to supply physical at 1250. And so it makes it very difficult for them to make that trade. That must still be the case. I haven't talked to Andy, but that must still be the case because we're clearly finding support around 1250. We found it again here today on Friday. There is also, from a technical perspective, the 50-day moving average, which has offered really good support for paper gold for the last, 4 to 6 weeks. We bounced right off of that level again the last couple of days. And so from a technical perspective, that's pretty good. And even deeper in the technicals, on a bigger picture of just a straight TA, the 50-day moving average and the 100-day moving average are both bullishly crossed and through the 200. The 50-day is also bullishly crossed through the 100. And that's just a scenario where a lot of these technical funds buy the dips because it's such a positive technical setup. In silver, I think maybe we might even talked about this the last time we were together, guys, how gold had been making higher highs for the first time in 3 years. It got through 1190, and then it got through 1230, and then it went all the way up and tapped the January 2015 highs just north of 1300. But silver was lagging. The first higher high that it needed to make was above 1638, which were the highs of last October. And once it got through there, it went through 1771, which were the highs of last May. But we've yet to get to the January 15 highs of 1860. Well, anyway, once it began to pull back, it became clear that it would probably pull back to that initial higher high thing that it had to break through of 1638. So kind of the old technical adage is what was resistance becomes support. Sometimes what was support becomes resistance. And so you knew once it started to roll over back on Wednesday, that's probably where we're headed. Hey, we bottomed out, I think, 1636. And then began to bounce. And so all we really did was a full retracement, came back down, found support at what had been resistance, and really there hasn't been any real technical damage done yet. So we'll see what next week brings. It's going to be volatile as heck. The FOMC has now made the market very sensitive to every single piece of economic data that comes out over the next 4 weeks. And then we've also got the expiration, as we call it, of the June gold contract. That's the current front month. There's still probably 300,000 contracts of open interest of June gold out there. But that contract goes off the board and goes into its delivery phase, in about 9 days or so. And so all of that open interest is going to get closed out, or all of it, maybe 8,000 contracts worth. and rolled out into August and December. And that's going to be adding a lot of volatility too. So maybe these levels will continue to hold, maybe they won't. It's like I said, the volatility is what's going to be most notable in the next week and a half.
Let's remember that there's been a lot of funds and institutions that have been waiting for a pullback to enter this move here.
Yeah, and see, that'll be the thing. You'll see maybe 30,000 contracts of June gold get closed out, get liquidated by some spec longs. But if they roll right back in and buy 30,000 contracts of August gold, or 20,000 August and 10 December, then the net change is nothing. And if it's done instantaneously, it doesn't have any impact on price. Where it can get volatile is if somebody kind of legs out that position. There's a big selling of 30,000 contracts, and then you don't put on the same position for 30,000 in August. You wait instead to see if maybe, hey, we sold this at 1260. Maybe we can buy some of this back at 1250 and lower. Now, the flip side can work too. There can be this big rush back in too if you got out at 1260 and all of a sudden we're 1270. So, like I said, the main thing that you can count on this next week and a half is going to be volatile. There are a lot of 1% intraday moves that are going to be ahead of us, and people just need to realize what's going on so that it doesn't catch them by surprise.
And we should also say, just for the sake of people in our audience who are not familiar with technical analysis, because a lot of our stacker community poo-poos it and is very skeptical of it, but the important point to remember is that a lot of people in managed money pay attention to this stuff, and it moves markets.
Right.
And what we are seeing now is a new bull market being, unfolding before our eyes, and the folks that pay attention to technical analysis use that to embolden themselves and in their investment decisions. And we are, in fact, even seeing a lot of new monies coming in through the Comex, even though the Comex is the, poster child nowadays, as you have been pointing out correctly so, Craig, for the most aggressive of manipulation efforts in the last couple months. I mean, the new monies are coming in. We have paper boys aren't necessarily our enemies per se. I mean, there are a lot of people, like even the Stanley Druckenmillers of the world, who are putting in lots and lots of money into paper gold. Unfortunately, it's paper gold, but it does move the markets.
Well, then that's what sets price. I mean, the spot price and everything else keys off this 23 hours a day that the electronic paper markets are trading. It's, as we all know, it's not a physical market. It's this hyper leveraged paper market that is what is recognized as setting the price. And so if you want price to go higher, there needs to be demand for those paper derivatives, for that exposure. And so there's really no getting around it. And we all know what's going on there. We all know what a casino it is. We all know what a fraud it is and everything else that goes with it. But that's not generally an accepted viewpoint across the broad investment universe at this point. And
98% of the rest of the financial world does not think of the world in the way you look at it and we look at it.
The proper way to look at it.
Right. I mean, they're happy with their paper.
So anyway, we all know what the limitations of TAR in a manipulated market. In fact, I've always claimed that what we do at TF Metals Report is actually manipulation analysis, because if you got to look at it from the bank's perspective. They know what the signals are that these trading funds follow. So if you can manipulate the signals and paint the charts to send a false signal, you can get these automated algo-driven HFT trading funds to do basically whatever you want them to do. That's why a lot of times, especially in the last 3 years, prices will get capped severely at like the 200-day moving average, so that then when you break the 200-day moving average on some news event like an employment report, well, then all these funds head to the exits at once and you go down $50 in a day. So we know that, and that just, all that does is belie the point that we can all talk about moving averages and all these technical signals, and we understand. I mean, all of us and everybody listening understands, the kind of the nullification of that by the manipulation. But if you're some hedge fund or some hedge fund manager or some technical analyst, whatever, that is, I guess, allocating some of your assets to an exposure to gold or across markets, and you have certain criteria that you need to see technically to decide whether or not you're going to open a position or add to a position, then the technicals are important. It doesn't matter what some stacker or what we think about the technicals. What matters is what the people that actually have the money think of it. And
it's almost
they
like
obviously
training wheels for them.
it is.
The
Well, that's
confirmation
true.
of
Or Eric, they chase the dot. They see the momentum, and they buy it. And you get this in the stock market. They buy it just because it's going up. You got to buy more.
Right.
And that's why all of that stuff's important. And so when we've noticed this year how, gosh, look at that. Every time the gold gets rated for $20, it comes right back. And look at all the dip buying. Well, the dip buying primarily is because of that bullish technical structure of the 50 and the 100-day being bullishly crossed and upwardly sloping away from the 200-day. And as long as that continues, we're going to continue to get dip buying. It's almost like a virtuous cycle. And hopefully, even through these expiration liquidations that we were just talking about, hopefully that'll continue, and then we'll get some sanity at the next Fed meeting in 3 weeks, and then we'll see what the rest of the summer holds.
And buying or selling simply based on momentum, like we've really seen over the last 5 years to the downside in gold and silver, it only works until suddenly the fundamentals overwhelm that, as the markets found out just in the past month with Theranos. I mean, that company's been overvalued, and everyone's just chasing due to the momentum until it comes out that all their test results are a fraud, and suddenly fundamentals take over again.
Imagine that.
So, I mean, it's really no different in any market. And so applying that to gold and silver, chasing momentum only works until at one point fundamentals snap the game.
You could say that's basically what we got to late last year, too. Anybody can look at the silver chart and see that silver came down and held $14 on numerous occasions over about almost a year and a half. September of 14 through December of last year? I mean, we've all referred to it as maybe that was the physical floor. That was the point at which they couldn't drive it any further down. Gold was the same way. I mean, I never thought we'd go below 1,200, but we went all the way to 1050. But then, hey, look at this. All of a sudden, we're back above 1,200. So, there's a point at which the paper price can really only be driven so far down by these speculators that don't really have an interest in the physical. The physical fundamentals do ultimately take. It's like the silver market. We all look at the gold-silver ratio, and people are left scratching their heads going, how can this be 75-1 when historically it's 15? Well, it's 75-1 because the paper markets aren't connected to anything historical or physical at all. All they're really discovering is the price of the paper derivative itself, because there's not like there's any physical delivery that takes place on the Comex. So the only price discovered is the price of the actual derivative. But that is what is allowed to, in a sense, create the spot price. And that's why you get this tremendous economic distortion of a 75-1 GSR. So one of these days, that'll all sort itself out. Andy Hoffman calls it economic mother nature. She'll blow back ashore before too long, and then we'll see how things look.
It might be a bit of a tangent, but I think it'd be interesting for the listeners to explain, because I don't know about you, Craig, but I get asked probably 5 times a week, why doesn't everybody in the Comex just stand for delivery and end this game overnight? I'm sure that's a question you've heard quite often.
Well, the primary reason is the position limits. I mean, it's like, hey, I know what you're going to do. Why don't you just go buy $1 billion worth of silver on the Comex? Well, the problem is the front month and delivery position limits. You can't. I mean, they're not going to let you. Now, it's okay. So, all right, we'll get Druckenmiller and Soros and 12 other guys to all do it really? Seriously, you think that's going to happen? And so they've structured the rules to keep it so that you can't do that. And that's probably the main result. Really, what we just have to wait for is just a delivery failure someplace. It doesn't have to come off the Comex, and there's not going to be one there anyway, because the only delivery that happens, and you can see it on a monthly basis. Is the house account at JP Morgan will take delivery 1 month, and HSBC will be the one that issues the metal out, and then you get to the next delivery month, and JP Morgan issues a metal out, and HSBC stops it all. It's just like this big circle jerk to create the illusion of some kind of physical delivery. It probably won't come from there. There will be a delivery failure in London. There will be a collapse of an unallocated account someplace, Australia or someplace. That will be where it finally comes from. And the Comex at that point will just probably, Either have to reprice or it'll
Right.
just go away.
And in addition to
then-
the Comex making it cumbersome, if not nearly impossible to take delivery,
Oh yeah, that's true too.
in addition to that, those using the futures are, some of them are traders are just speculating, but most of the market participants, they're simply using it to hedge. When you have a mine that's going to sell 2 million ounces of silver, when they put on a futures contract, they're not looking to sell or take delivery of that silver. They're simply trying to hedge or freeze in their profits, and on down the line, as far as the physical markets, I mean, you talk about, say, an authorized purchaser from the mint or a private mint. Unless it's a private mint that the market's tight and they can't get supply directly from the mines right now, okay, I'm going to take delivery of a few 1,000-ounce Comex bars to get some supply. Other than that, the whole downstream cascade in the market is simply looking to reduce their risk exposure to the market swings in the spot price. So it's not as simple, why won't these guys stand for delivery? It's that they're not, if they're hedging, they're not using the market to try to acquire silver or gold. They're using the market to try to reduce their exposure to risk of spot or market price swings.
Or just simply for profit, Doc.
Right.
You
Or
know,
the
I mean,
speculators just simply for profit.
or and the banks simply for profit too.
Exactly.
You know,
the banks aren't looking to take delivery
No.
at all. They're just looking to rape and skim off of everybody else.
Yeah. I mean, it gets
Yeah.
down to the nature of the participants in the marketplace, and the market that we have in the Comex is a rather unusual beast because it's not like the way people envision what futures and markets are supposed to be in terms of intermediation and price discovery.
Right.
Yeah.
The participants there are not normal participants, and that's why we have this movement to create new markets. China and being the tip of that spear.
And think about and realize this too, everybody listening. You know, there's always this talk about the commercial hedgers, and as if the Comex is somehow the perfect marketplace of hedgers and producers looking to sell forward and speculators taking the other side of the trade. You know, like that's why they set up the Chicago Board of Trade 100 years ago. You know, that's how, and the Comex
Right.
is a reflection of that. No, it's not. I did a webinar yesterday with Steve St. Angelo, SRS Rocco, who I'm sure you guys know. And he just wrote something, I don't know, Wednesday, that he posted again, the hedge book size of the gold producers, which like 15 years ago was something like 2,000 metric tons a year they were hedging on Comex. And now it's like not even a tenth of that. It was 130 metric tons in 2013. So even if we say maybe they've come back and they're doing a little more here in 2016, what's it going to be? 200 metric tons? Okay, that's fine. But on the for the banks or the commercials in general on the Comex, they're up to like 600 metric tons net short. So there's a 400-ton difference. And okay, so is that commercial hedging then, or is it just banks taking the risk that they can outlast the shorts or the longs? I mean, the spec longs, by just simply, piling into a position and making it bigger and bigger, putting good money after bad, just hoping that eventually they can crash price and buy their shorts back. I mean, these banks it's not all hedging. This idea that, we're going to get another COT report here on Friday, and there's going to be people that assign legitimacy to the futures markets and say, oh, look at all the smart money is on the short side.
Right.
There's no smart money one way or the other. There's just the speculators on one side, and there's the criminal banks on the other. And that's really all there is to it.
Historically, futures markets functioned in the neighborhood of 10, 20 times, underlying speculation versus underlying physical commodities being traded. Nowadays, we have this carnival circus. It's like this insane casino that has no connection to reality.
And that's exactly where we are in 2016. And what people say, well, it'll never end. No, it will. And that day is coming when there is just all it's going to take is one delivery failure. when, because it's kind of a confidence scheme. And I think we talked about this last time we did this. It's kind of like a supermarket that manages on a just-in-time delivery, manages off of flow. And the bullion banks are in there.
Right.
Again, what you see on the Comex and the trading is just a fraction of what's going on in the global gold market. And the bullion banks are in there primarily in London, desperately trying to match up orders, and they've got orders to fill physical here and tons there and tons that they've got to allegedly deliver to the GLD if it keeps going up, that kind of stuff. And they're on the hook for this physical delivery at some point. And on the other side of that are the people that are getting conned, that are willing to play the game with unallocated accounts and paper certificates for gold because they feel as if, well, if I ever really need my gold, I can get my hands on it. Well, the first time there's a delivery failure, and that day is coming, all the people on the other end of this confidence scheme are going to go, whoa, wait a second, hey, I'm going to get mine before everybody else gets theirs. And that's when the music stops and everybody's scrambling for a seat. Whether that happens next week, next month, later on this year, it's going to happen, though, because everything points anecdotally to a drainage of the supply in the West. The central banks aren't giving gold to the bullion banks to lease out anymore. The actual central banks are buyers. We just got numbers today. Russia's buying another 15 metric tons here in the month of April. At some point, the stock is gone, and they're unable to even live off of flow anymore. And then that's when it gets really interesting.
And it isn't necessarily even something that's going to be identifiable as a singular event. It could be a process delivery failure, so to speak.
Yeah.
And I like the fact that you emphasize that it probably would not be the Comex, because a lot of people tend to focus on the Comex or maybe secondarily the LBMA. But in terms of global shocks to the overall bullion trading system, I think it's far easier to see it somewhere else. And in fact, the OTC market is maybe 10 times larger than Comex. So the reality is that Comex is a little play toy that the authorities have been able to sequester with all of the way in which they manage the markets, and that's not where it's going to all fall apart. However, it is amazing to watch today and yesterday, with miners going up as well, that the 95 some odd percent of conventional thinking monies in the world are buying this dip. And if this was this time last year and we were talking about a big hit that we had over some FOMC minutes or whatever, we would not be seeing the action that we're seeing as we're recording now around the noon hour, give or take, on Eastern Standard Time Friday. I mean, we are seeing this market already repair itself, and that's exceptional trading action indicative of a new bull market that is snorting rather well.
It is,
very
Eric.
healthy to see.
It is, Eric, and that's a critical distinction. It's been a hard thing to get your arms around. I mean, I started getting really nervous in the middle of February already because open interest had expanded so far, and the commitment of trader structure had all gotten back to where during the downtrend of 2013 through 15, every time that COT structure, as we called it, got to those extreme levels, price raids happened. You had a string of lower highs and a string of lower lows and a clear downtrend in place. So when we got back to those COT and commercial extremes in February through March and all the way to this day, you thought, oh boy, hammer's going to fall any time. But the critical thing that has changed is that we're no longer in the downtrend, that we have broken out from all of those downtrends. We have made higher highs. And even on top of that, at no point, holy cow, in 2013 through 15, did you ever see the miners double and triple. I mean, if anything tells you something new is afoot, the miners all through those 3 or 4 years, all they ever did was go straight down, lower and lower and lower. And now we've gone up, 135% in about 100 days, and gosh, giving back 10% now in the last 3 weeks. Well, geez, if we've only given back 10%, that's pretty good. That's a normal little healthy, profit-taking correction. And that's a pretty strong sign that something has significantly changed. And it's another reason to think that this is all probably transitory, and we'll probably keep on grinding higher.
Yeah, and the 95% of managed money around the world slowly waking up to the Stanley Druckenmillers are, poster child of that. And
and
and Eric, on and on.
Eric, too, and Doc, you might remember, I sent this. I kind of rediscovered something about 2 weeks ago, and I was tweeting it and posting it and everything for a couple days in a row. And it was that presentation from Grant Williams that he gave at some conference at the end of December, and then he put it out on YouTube like on January the 6th, and it was called "Nobody Cares," and it was just great. And if anybody listening to us wants to go look it up, just type in Grant Williams "Nobody Cares" into YouTube, and it'll come right up. And one of the great segments of that is he talks about in 2015 the global allocation from all global pension funds. Some big report that came out in 2015. All global pension funds had a cumulative allocation to gold and gold equivalents of 0.15%. Because that's right there is nobody cares. But if global pension funds were to just simply double that allocation to 0.3%, now that's not physical gold, that's gold equivalents, that's ETFs, miners, and all that stuff. That little bit of change would cause enough inflow that you could buy all of the stocks in the GDX, all of the stocks in the GDXJ, and every single share of the GLD. So what you're saying, Eric, about, gosh, these institutions start paying attention to gold, and why wouldn't they with negative interest rates and everything else going on that seem to be a permanent part of life now? Things could get disorderly pretty damn quick. So you see these little pullbacks and you think, well, maybe they are a pretty good opportunity, and they may in fact be.
Well, that's what the tape is saying. That's what the market is indicating very clearly. And even when we get these February 11th spikes to 12.63 and 90 cents or whatever it was on an intraday basis for gold, and we consolidate for a long period of time and then recapture that and keep going back up, and then the miners roaring the way that they are, people are waking up. And we've, since 2014, the S&P 500 universe of corporate earnings going down the toilet bowl, and this artificial reconstruct we have in our credit markets worldwide, with Europe being the most obnoxious of it all. But it's insane for any fiduciary responsible money manager to continue to think that the central bankers have their back in this environment. And maybe Freudian slip, their bank too.
And if we're talking about just a mere 0.3% allocation to the sector is going to totally wipe out the entire share. I mean, you're talking about totally acquiring all the miners, extrapolated to bullion. I mean, the U.S. Mint can't even keep up supply right now, and nobody cares. I mean, the U.S. Mint sold 22 million coins, and today is May 20th. So they've sold 22 million coins. They can't even produce enough coins right now, and nobody cares.
Well, and just before we move on, one extra bit of perspective, just so that people keep their eyes on the ball, because, we had such a tough day. Wednesday, the Fed and the FOMC minutes and all this stuff, and oh boy, here comes a correction. Okay, well, 4 weeks ago today was April 22nd. We closed that Friday at 12:40. So here we are 4 weeks later going out, 12:30. Here we are 4 weeks later going out at 12:55. That's $25 move. That's 2% in a month. Mm-hmm. I don't know, what asset class, what asset manager wouldn't take 2% in a month. That works out pretty well. Additionally, at the depths of the pit of despair, remember the pit of despair that Wesley got cast into in The Princess Bride, right? We were all down there in the pit of despair back in December. If we had fast forwarded, and I said, or maybe the three of us were talking then, I said, hey, guess what? Hey, Eric, Doc, let me let you in a little secret. By May the 20th, gold's going to be $12.55, and the Hui is going to be 215. We all have been like, holy cow, that's awesome. So I think everybody needs to kind of keep things in perspective. Yeah, it wasn't any fun to watch things go down on Wednesday, but I mean, grand scheme of things, this has been a pretty good year so far.
And these jawboning Fed speakers are flipping around with their groomed language as well too. I mean, you never know what they're going to switch when it comes to whatever they want to do for public relations purposes. The economic policy in the United States has largely transitioned to one of management of prospective economics, and whether you see it in the financial markets or the unemployment report skewings and all of the other statistical shenanigans that the powers that be run, the level of surrealism in our markets today is something that you talk about things that one could never have imagined. And you asked me 25 years ago what I would have thought markets would have become today.
Yeah.
Holy cow! I mean, this is just unbelievable how people are buying into basically a manufactured reality. I mean, whether it's precious metals or the bond markets or the stock markets, whatever. I mean, we're shaping up for something that's going to be monumental in terms of the unwind of all of this, the artificial credit created and fake reality.
In paper. It's their drive of everything into paper, just like getting rid of paper money and driving everybody into, digital money. That kind of is to that same end. But back to your point about the Fed and just the reality of what was actually said, because this kind of got lost in the translation. Everybody was so worked up that the minutes didn't match the headlines from 3 weeks earlier. But the main line they said was, we still hope to have a live meeting in June, but it'll all be based upon the economic data. Okay, well, if this is from a meeting that concluded on April the 28th, well, let's talk about the data that's come out since April the 28th. The GDP for the first quarter came in at a whopping 0.5% growth, if you want to call it that. And the employment report for April was a horrendously disappointing 166,000 part-time jobs. And so even though the Fed said, hey, we're going to make a live meeting, they also said it's going to be data dependent. And the data since this last meeting has been terrible. But that didn't matter. The high frequency traders all seized upon the headlines. Then you got this big move in the dollar and a subsequent move in the yen, and everything else kind of keyed off of it. So I'm not too worried about ultimately where it's going to go in June. And if I might just add one more thing, what people have to remember is really three main points. One, gold was $1,060 per ounce on December 17th, the last time the Fed raised interest rates. So maybe we ought to be pulling for one. Maybe that's what we should hope happens in June. Maybe we'll get another $200 after that. So that's
all this will they or won't they? I think if they do follow through in their threats and they raise rates any further, I think gold's going to surprise as to its response. I think it's going to continue to rally.
Well, there you go. And then the second, then there are two other points. One, all they're doing is flattening the yield curve. The 30-year long bond and the 10-year note have all declined in interest over the last 100 days or more than that, simply because everybody else in the world is negative. So there's nothing else to buy if you're searching for yield.
And it's also an economic downturn indicator, too, worldwide. Exactly. People are recognizing that, we're in a huge deflationary funk.
Right. And these goons at the Fed, if they're anything, they're at least Keynesian educated, and they know that a flat to inverted yield curve is a precursor of recession. So if these morons were to actually follow through and raise the Fed funds rate to 1%, you'd have a 2 to 10 or a 1 to 10 spread of like 50 basis points at that point. I mean, they're not going to do that. And then lastly, and this is probably even the most important part of it, is how many emerging markets, China included, have their currency pegged to the dollar. And so when the dollar's rallying, they're dragging up the Chinese currency as well. And that's not what they wanted, which is why after the Fed raised rates in December and the dollar index was near 100, that's when you got this significant bunching, almost daily devaluations that were coming out of China. And that's what then spiked the yen, drove the dollar yen lower, and washed out the stock market down to 1,800 on the S&P. If they persist in this talk, if they persist in jawboning, if they were to somehow raise rates in June, we're going to be right back to where we were in December with crashing stock market again. And
the Chinese sent a missile across the bow of the Fed 12 hours after the Fed did their minutes release. They devalued their currency precisely because they do not want the Fed and the Treasury and all of the economic stewards of our crazed monetary world thinking that that they're going to let the dollar rise enormously. And a lot of what's going on is this currency war dynamic. I mean,
Yep.
it's very, very clear that China has been trying, and with, to some extent, I'd argue, with the acquiescence of Western central banker participation, seeing Japan and the euro, or the yen and the euro, rise versus the yuan. And that's how China has been able to deal with a kind of a clandestine, not in a straight line, of course, but a clandestine devaluation of their currency so that they can help, in their theory, promote their export market.
Yep.
And with the dollar shooting, I mean, the dollar was falling apart earlier this week and last week, and the momentum going to the downside was pretty strong. And I think that in part was what motivated the cycle of jawboning as vociferously as they have in the last couple of days, speaking towards June and July as a so-called possible meeting for raise. And, by the way, what do you think of this live meeting terminology? Is that because of the press conference in June? I'm trying to figure out what this new creature that they have coined in terms of the term live meeting. I guess that's because of the press conference once every four meetings out of the year.
Yeah, after 100 years, the creature from Jekyll Island comes alive.
Yeah, they fry it. Give my creature life. I'm thinking of Gene Wilder. Yeah, it's like you said, though, Eric. It's all jawboning and management of perspective and trying to get the markets to do what you want them to do. They put out the statement at the end of the meeting, and the dollar index over the next 4 or 5 days crashed from 95 down to 92. And then all they did was jawbone 3 or 4 goons a week, culminating with the minutes released back on Wednesday. And guess where the dollar index is? 95, right back to where it was. And so it's mission accomplished in that regard. It'll continue. I would be flabbergasted, but like I said, maybe we should be pulling for them to do it in June, just because we know eventually how that's going to play out, and it certainly helped drive gold higher last time. And I don't know how much more time we have left, Doc, but the other thing that since the last time we did one of these that I think is extremely important for people not to lose track of, besides the Deutsche Bank thing, which is hugely important, and anybody that says it isn't is either completely clueless, naive, or selling something. The other thing that is hugely important, even more so perhaps, than the admitting of the rigging and Deutsche Bank working with the regulators to bring, to sing like a mafia informant, is this Chinese Shanghai yuan-denominated fix. First time in 97 years that there has been a competing fixed structure to what takes place in London. And this is the hammer. This is the Chinese just having this now in their toolbox to drop whenever they want. And what do I mean by that? On any day they want. If they want to increase the flow of gold, if they want to effectively devalue their currency, they could set that yuan fix $50, $100 above where spot is currently trading. They'll set off an avalanche of physical arbitrage because it's a paper market in London, but it's a physical market in Shanghai. They could set that spread high enough to set off an avalanche of the remaining physical heading out of London and just completely wipe out the bullion banks at any time they want. They could do it tomorrow if they wanted to, now that they have the fix in place. So they could always do that. And like I said, the other thing is by forcing the price higher, in a sense, it would almost be like a yuan devaluation too, just like if the U.S. suddenly declared it wasn't $35 an ounce, it was $3,500 an ounce. So that development, though it's kind of fun to watch every day, and clearly there have been some changes to how the trading patterns of gold are and how they work over the last month. The development of that just being a massive system-smashing hammer is something that everybody needs to understand is just sitting there in their toolbox now, waiting for them to use whenever they decide they want to.
And just the existence of the tool itself isn't, useful to China and their policy objectives. They don't necessarily have to use the tool to benefit from it.
Right, and it's definitely changed. Andy Hoffman has written about this. He calls it the cartel herald. Really, anybody, especially if you're North American based and you follow gold, you get up any time in the last however long you've been following it, and you get up 4 days out of 5, you look at the Kitco chart and you see price went straight in the toilet about 2 a.m. And you're like, what? How come this happens 4 days out of 5? I mean, it just happens all the time. Adrian Douglas wrote this great piece in 2010, God rest his soul, about how, and quantifying it, and that if you just simply bought or sold gold every day at the Comex close and then bought it back at the Comex Open after London was done with it, you'd make all, I mean, it was amazing, the study that he did. I sound like Donald Trump. It's amazing. Everybody can see it, It's, anyway, that pattern, especially since April the 19th, when the Shanghai fix began, has completely changed. And now, anybody in North America can wake up. They will see the price fall during London hours maybe 1 day a week instead of 4. And now the onus for managing price and driving it back lower has apparently fallen to the bullion banks and the Comex. Because now you saw, hey, pull up a chart today. We rose overnight $5 or $6 from midnight Eastern all the way till shortly after the Comex Open, and we get to about 1260 and get to about 10 o'clock Eastern time, and then boom, down $10 we go. It is the consistent pattern for the last month, and clearly related to this changing of how the global gold market works ever since that yuan fix. The tool is now there. Whether you see it as a massive hammer to break everything, which it could be, but it's also there. It's also clearly have an impact on a daily basis too.
All right, I think we'll wrap up the show there. I wanted to discuss a little bit about the end game playing out in Venezuela, but we'll have to wait for next week's show for that. But it really is, guys. It's shocking even to me to see how fast the end game of socialism is playing out in their hyperinflation over there in Venezuela.
Just don't talk about that on college campuses. You're going to send all the crybabies to their safe rooms.
You probably just get blank stares. I doubt anyone at a frat house could understand the word hyperinflation.
Good point.
They'd be thinking about something else.
Good point. And I think in terms of Venezuela, the best advice I can give everybody in terms of Venezuela, just stay the hell out of Venezuela. How's that?
Well, Venezuela may be coming to us.
Well, that's true. But for now, just stay out of Venezuela. Yeah. Whatever you do.
Before we wrap up,
we're not going to see Craig flying out there like Luke Redkowski?
Do you remember that was always where, in my cartoons, that was always where Cartoon Blythe and Ruprecht the Monkey Boy, they were going to flee to Venezuela. Remember that? So if they did, they're getting their comeuppance now, at least.
Before we wrap, Doc, what's going on in terms of people's reactions on the bullion front? Have you been seeing a spike in orders after Wednesday?
Both, ever since Wednesday morning, order volume has exploded. We saw probably about a 4 to 5 fold increase in order volume from what we saw earlier in the week. Overall in the industry before Wednesday, things had cooled off a bit. And again, a bit needs to be taken into perspective because, as I mentioned a little bit earlier, the U.S. Mint's still allocating coins and cranking out 1 million in a week. And demand's still, historically speaking, very strong, but it has cooled a bit from what we saw Q3, Q4 last year. I mean, we're not really seeing that at SD Bullion because we're still growing like crazy. I think we're on pace to double again this year. But from all our contacts in the industry, everybody we buy from, the authorized purchasers and the mints, until Wednesday, things had slowed down a little bit. But yeah, the demand has roared back to life here. I mean, you're talking silver is at about a $1.50 discount, and gold, down about $40, $50 from the high. So it's definitely an opportunity for people who'd been sitting on the sidelines waiting for a bit of a pullback, that they're seeing that, and they're pulling the trigger and making the purchases.
What about indications as far as new monies coming to the sector? Is there things that you see that are interesting and worth pointing out? I
don't think anything off the top of my head that we haven't discussed recently. No new big developments over the last week or two in that sector. We really saw more big money move into gold, especially in the early stages of this move earlier this year. So we're not really seeing that right now that we saw really in the early stages as gold started to move off 1100. There's a lot of big money coming into gold.
And then earlier this year, too, you were noticing that they were getting an incrementally larger new flow of new customers, as opposed to, just the people have been waiting and stacking and buying dips and so forth. Have those trends continued on through now, or is it kind of just growth across the board just because SD Bullion is growing from a small base, and that you being so focused on silver with the web presence that we have, it's not as comparable to, say, APMEX, for example?
Yeah, it's definitely not as comparable. I mean, across the industry, the average bullion dealer and definitely somebody like APMEX, they sell a heck of a lot more gold than they do silver. And they're frankly, everybody we talk to is shocked when they find out we sell probably 60 to 70% total dollars worth of silver versus gold. Nobody else sees that. Nobody else markets to that. Golds were the big money and the money to be made is typically. But so yeah, a lot of it is that we come from silver doctors. We believe in silver, so it's no surprise to me that we move more silver than we do gold. All right, well, I think we lost Craig. He started his nap early.
What? Huh?
He said we need to keep this short because I'm already half asleep. I'm going to be napping for a couple days here, guys.
Yeah, Turd's a little under the weather, but no, I'm still here.
We hope you get better soon, and hopefully next week's market action will help kick you into gear, Craig.
Thanks, guys. Yeah, it's going to as we began the show. There's going to be a lot of volatility, and we're just going to want to watch to see if that dip buying keeps hanging in there. Because if it does, there's no reason to think, as the truth finally wins out over the next 4 weeks, that we won't look back on this as a pretty good buying opportunity.
All right. Well, thanks for joining us, Craig. You can check out all his excellent stuff over at TF Metals Report. Check out his Vault subscription service. I know Eric and I both are subscribers and I highly recommend it. So that can be found over at TF Metals Report. So keep up the good work, Craig, and thanks for joining us.
Hey, thanks, guys. It's always a pleasure.
All right. For the Doc, Eric Dubin, and the Duck, Craig Hemke.
Elmer Fudd.
Better known as the Turd. Thanks for tuning in to this week's SD Weekly Metals and Markets.